And what's happened is all the refiners have basically quit. Elemental, 1 week ago when I was in Florida visiting my friend's coin shop, they said, we're no longer taking silver scrap, we're only taking gold. Well, just yesterday, they announced we can't take gold. They're full because everybody's dumping at these prices. When you're sitting here at over, $111, $112 silver, and what 50 something, what is gold price right now? 52.74. Oh, silver's at 113 at time of recording. People are selling like mad. Well, I'm about to become very unpopular, probably with about 53% of your audience, depending on the makeup. But some of this has to do with tariffs. Some of it's general de-dollarization. And I have another term for you other than de-dollarization. But the people are starting to write that the tariffs have caused negative effects on the economy because it's forcing, not only is the U.S. end consumer forced to pay the additional amounts if they want those goods that are being tariffed. So we're the people that end up paying them. But it's because other markets can't sell into our market as easy, is causing them to find alternatives. And when they find alternatives, they demand the dollar less because they're doing less trade with the U.S. And now it's very fashionable to do trade deals in local currencies. We're in a multipolar world. It's been this way probably for about 2 to 3 years, where last year the U.S. dollar for the first time was below 50% of world reserves of currencies used for trade. And that trend has continued. Of course, in the World Gold Council Survey 2023, central bankers said that was going to happen. And they said that they expected us to get down to about 45% of reserves by, I would say, next year. And we're right on pace for that. Central banks said that was going to happen. It's happening. The tariffs have only kind of put additional pressure. And so there's less demand on the dollar. So the dollar relative to other currencies is not as strong. It's not being demanded as much. And it's, this is one reason, this with the other bad economic data, because there is some out there, is why the Fed's considering, easing. They're not going to ease today. I think the day we're recording this on the 28th, the Fed is expected to hold rates steady. They want to see what's happening. And one of the things that they want to see is corporate earnings. We have Microsoft earnings coming out today. In fact, I'll list several of the earnings that are going to be coming out today. Microsoft, Tesla, AT&T, ServiceNow, Progressive, Starbucks, General Dynamics, Corning, Waste Management, some really big companies there. And early on, the earnings reports look good, but they want to see. So according to FactSet, as of today, with about 13% of companies reporting their fourth quarter earnings, we're sitting, 69% of them have recorded an earnings growth, which is good, 69%. And a little bit less than that have recorded some sort of earnings surprise. So there are earnings there. Of course, we still have 87% of the results to go. It is also no surprise that the Magnificent Seven, which include a lot of the big tech companies, are carrying it. So far, their earnings are 20.3% versus the rest of the S&P at 4.1%. So the top seven are really carrying the entire index. The rest of the index is profitable, but not to the level the tech companies are. And then that leads into my next point, which is AI and the replacement of American jobs. There have been a lot of mass layoffs that have gone on in the past year. I was surprised to read recently that UPS laid off 48,000 workers last year. And that was really quiet because, I hadn't been reading about the layoffs. They must have done it very quietly over the year. So there's a lot of layoffs coming because of the initial wave of AI, which is taking jobs over. And you and I were talking before the program, people are commenting that AI doesn't really supplant all of the skills of the average worker. And it doesn't, because it's not fully conscious. It doesn't have the collective knowledge of the American workforce. And it doesn't have the decision-making, specifically the heuristic decision-making capabilities. But AI has affected computer development, auto jobs, things like that, which were repetitive type of tasks that the computers today can do very well and make those decisions. Those jobs are already being replaced. Also, if you look at Amazon, UPS, and those types, a lot of their warehousing has been replaced by robots and different versions of software AI. So what you're seeing is American companies are profitable. Mostly it's the tech companies because they're capitalizing on this replacement of U.S. workers and the supply chain, the technology in it, whether it be physical devices that do the work of a human or AI intelligence.
On the surface, corporate America appears healthy. Earnings reports remain strong, particularly among large technology firms. But beneath those numbers lies a growing imbalance. A small group of companies now accounts for a disproportionate share of profits, while most businesses see modest growth at best. At the same time, workers face stagnant wages, persistent inflation, and declining job security. Household debt delinquencies, especially auto and mortgage loans, are climbing. The economy is generating profits, but they are increasingly concentrated, leaving the average worker with less purchasing power and fewer financial buffers than in past cycles.
And that's led to some nice earnings results. However, the mass layoffs have begun and is starting to affect the economy as well. In an era of high inflation, in fact, I'm going to bring another couple points into it. I'm going to do sort of around the world answer. We were talking about bond rates. The U.S. 10-year bond is up over 4.3%, which is not good for things like mortgages. And as I look at mortgage reports, according to MBA Mortgage Bankers Association, the delinquency rate for mortgage loans on 1 to 4 unit residential properties, which is the bread and butter of the American household, adjusted to a seasonal rate of 3.99%. Now, it's nowhere near, back in 2021, where it was around 11% during the pandemic, but it has ticked up and stayed up. And auto delinquencies are also very high. As I look at bankrate.com, auto delinquencies are almost 4%. And they were last at that rate during 2009, right before, during the height of the Great Recession and the big crash. So we're almost at the rate. We're about a half a percentage point off on auto delinquencies where we were from the height of the issues from the Great Recession. So even though corporate earnings are up slightly, it's not the American consumer, the American worker that's benefiting. Their pay increases have not kept up with inflation the last 10 years. There are less overall jobs. If you look at labor force participation rate, more jobs are being replaced, hundreds of thousands of jobs. Amazon today announced 16,000 in their data centers would be replaced, and that's largely because of automation and streamlining that they're able to do. There's been tremendous downward pressure on household earnings. Oh, also one last thing, I was looking at unemployment and it's up to 4.4%. But if you look at the latest household data survey that the US government does, a lot of these jobs that are affected by AI, auto jobs and computer science jobs are the ones losing. So it kind of tells the tale that the AI has been a bit of a boom for the corporate sector, but it's not been a boom for the working class part of the sector. And while AI still has a long way to go, I think this is the beginning of a trend in which people can expect there to be less good paying jobs to go around. And it may result in a changing of the American workforce. It's funny, I was watching a commercial this morning, and it was, I think, one of these trade schools, United Technical Systems or something, I forget what it was. And they were talking about, being an AC tech or being a auto mechanic and how that can't be replaced by AI because it's a physical component. And I think that we're seeing a reshaping of our economy. Maybe we get Trump's wish and we go back to a manufacturing economy, maybe for that reason, because people aren't going to find jobs elsewhere. But I think that's what's going on. We're just rotating into a different economy. And, most of the dollar weakness has been on tariffs, and it's been on those types of things. It could come back because as the tariffs ease and we stop using that as sort of a weapon in international relations, perhaps the dollar will come back a bit. But I think the genie's out of the bottle on the dollar. I don't think it's ever going back to its heyday. I think once these contracts and deals are done around the world and they realize they can do it outside the dollar without dealing with all the political crap, I think that more and more people are going to adopt that. So, the term I wanted to bring to you was de-Fiatization, not just de-dollarization, because a lot of these G7, G10 economies are essentially getting rid of physical cash and they're going to digital currencies. And that type of development is becoming more and more prominent, especially. And if you look at the SWIFT system, as people come out of the SWIFT system for international payments, they're using things like blockchain and CBDC technology to make these payments. And so it's only going to accelerate the death of the dollar. And I fully expect all world currencies eventually to burn up, like all have done in history. And the US may be the last one standing, but it's not going to survive, I don't think. I think what's happening is there's a re-engineering of payment systems as the world economy has to deal with these issues. And by the way, the U.S. is not the only one with the issues with inflation and, delinquencies and less labor participation. There are a lot of other countries in the world that have the exact same problem.
Artificial intelligence is rapidly reshaping the labor market. While AI has not replaced human judgment or creativity, it excels at automating repetitive, process-driven work. Warehousing, logistics, software development, and manufacturing support roles are already being streamlined or eliminated. Corporations benefit from lower costs and higher efficiency, but workers bear the adjustment pain. Layoffs have accelerated quietly, often without headlines. The first phase of AI adoption targets obvious inefficiencies. Deeper structural changes lie ahead. As productivity rises, job displacement is becoming a defining feature of this economic transition, particularly in middle-income occupations.
Well, you did mention the AI bubble. We're going to take a look at a recent highlight from Microsoft CEO Satya Nadella. This is from the World Economic Forum. Let's see what he had to say about this. I think a lot of people in the audience will be kind of surprised. So let's go ahead and pull him up.
Are the tech for this not to be a bubble?
Yep.
By definition, it requires that.
Can you hear him, by the way?
Yeah, I can hear him.
The benefits of this are much more evenly spread. I mean, I think a telltale sign of if it's a bubble would be if all we're talking about are the tech firms, right? If all we talk about is what's happening to the technology side, then that's it's just purely supply side.
Right.
Ultimately, if we are not talking about, wow, here is a drug that was sort of brought into the market that's super successful because it was AI accelerated the clinical trial. It's not even the magical molecule, right? It's kind of even the rest of what is needed in order to make something much more relevant, right? And by the way, it's happening, right? So I'm not sort of saying that. That's why I'm much more confident that this is a technology that will, in fact, build on the rails of cloud and mobile, diffuse faster, and bend the productivity curve and bring local surplus and economic growth all around the world, not just economic growth driven by capital expenses, because it's a narrow point in time calculation. It's
right now, that's what we're seeing more.
That's what we're seeing, in the developed world in particular. But remember, my capital, like that, the one thing that, is definitely we're spending a lot of it in the United States, but 50% of it is also all over the world. And so, interestingly enough, it depends on demand all over the world, and the demand all over the world will only be there if there is local surplus all over the world. And so that's sort of the way I see the equation.
There's a couple things I want to say to that. So when he's talking local surplus, as we've already seen in the United States, that surplus is going to be focused around the corporates, not the people. And that's the key thing to understand. When he's at the head of an organization like this, he's looking at how do I create surplus for my company, not necessarily how do I create the most, the richest working class. And when they put these in these terms, it makes people think, oh, local surplus, I'm going to have more doodads, at my local Walmart. And that's not what he's talking about. He's talking about surplus with which the larger corporations can continue to grow their pie. And he's putting it in a term that seems like we're all going to benefit. It's going to be warm and fuzzy. But no, he's thinking about his company as a leader of the company. And that's the first thing I want to put out there. The second thing that I want to put out there is he's right. We're in the first stage of it. And it's kind of like if you go back to my consulting days. In consulting, you can do like a Lean Six Sigma thing, and IBM did it. And then the guys from IBM came over to Verizon when I was at Verizon. And the first 3 years of Lean Sigma are just getting rid of obvious waste. And that's what AI has done. Waste in terms of where can AI do it better than the person, which is repeatable programming techniques, automated of machines, that type of thing, where easy, low-hanging fruit, where AI was applied, where you can replace that human labor. And that's sort of what happens in any sort of changeover in systems is you go after the low-hanging fruit first. And that in Lean Six Sigma, you're going after getting rid of inefficient processes. Or if you look at Doge, what Doge tried to do is get rid of payments that didn't need to be there, that weren't authorized. And similar to Lean Six Sigma and to Doge, the real work comes after that. Because what happened when they went to Doge and tried to clean out the system, they realized that most of it was authorized spending. There was billions of dollars that was not authorized or was corrupt. but the vast majority of it had been voted in by a program in Congress. And when they did the rulemaking, and this is something people in the US do not understand, I know because I've been on the political trail as a lobbyist, it's the rulemaking after the law that matters. And depending on the rulemaking, you can move that money around in about 50 billion ways. So the rulemakers have as much control over where that money gets spent, and the bureaucrats that adhere to the rules then does the legislation itself. And so what happens is most of the money that was being misallocated was actually legally being misallocated. So the real change in DOGE would have to come from a redesign of the underpinnings of the system, the principles of the system, and how we spend, authorize, and rule make, for money spending here in the United States. And Lean Six Sigma is the same way. The second half of Lean Six Sigma, the last 3 to 4 years, is where you get the real change. It's where you go in and say, okay, we've gotten rid of obvious waste. Now, how do we actually modify our business process to be more efficient? And then that's essentially what AI is doing. It's coming and knocking out the lowest hanging fruit at first, but then to really make change, it's got to go in and change the system itself. And what he said, what the Microsoft CEO said at the end was really the key. It's building on the rails of cloud, and it's also going to build on the rails of blockchain technology. AI is going to come into play there. And that's where you're going to start to get real change, but that's going to take time. And that's really the longer term value of AI, is reconstructing supply chains and reconstructing manufacturing, and eventually reconstructing the workforce to where corporates get the cheapest labor that they can, and that they get the cheapest process they can to meet their quarterly reports and their year-end goals. And again, I want to reiterate, that's not necessarily to the benefit of the average American worker.
The bond market often senses trouble before the headlines do. Rising long-term yields reflect growing concerns about inflation, fiscal deficits, and debt sustainability. When government borrowing costs approach historically dangerous levels, servicing debt becomes increasingly difficult without monetary intervention. This pattern has repeated across centuries and currencies. Central banks may attempt to suppress yields through easing and liquidity injections, but doing so risks further currency debasement. The current environment, high yields alongside slowing growth, suggests mounting stress, not resilience, in the underlying financial system.
This is one of the traditional analysis which does hold true, in that, to add some additional flavor, right around 1974 when the Commodities Act came out, we started trading derivatives on gold, silver, and other products. And that's part of the reason in which silver went sideways, because it was being traded as industrial commodity and everybody wanted it cheap. But if you're right, if you look at times in which we've had financial distress, and the bond market is always the best overall individual indicator. You always want to look at 10 or 20 things, what I do.
It's the biggest
market really takes into account many of those factors for you. If you just simply look at the 10-year bond, a lot of times that will tell you the overall direction of the economy, often before any fallout from recessions. And, I've been covering bonds on my channel. I covered them for 4 or 5 years, but the last 2 years I've paid attention, because once you get into that 4 to 5 to 6% range of interest rates is when the government starts to have problems servicing debt from tax receipts. And so that puts the government in a tough position of what do they do. If these bond rates, if they get to 5%, people have said it could totally break the economy. I don't know if that would happen right away. But those interest, and we're not talking.
But interestingly enough, Rob, that's where they've been consolidating the last 3 years.
Yeah, and this is not just the United States. This is throughout history. Throughout history, any sort of modern, the last 150 years where we could track interest rates on Treasury debt, when it reached that 5%, that was always the warning indicator that you were going to have a currency failure. And we've gotten awful close to it. And this is with the Fed playing around with the short and long-term curves. We have Fed interventions. So what they're going to do now is the Fed is going to print and ease, and they are going to try to make the economy better, which would seem to, at least in the short term, lower bond rates. But I don't think that the rest of the world really buys it. And I think it's just going to inflate it even more. In other words, we're going to come to that melt up phase where everything melts up and then it crashes. And we're not there yet, but you can tell by the way bond rates are going. And, by the way, that's why Trump and his administration wants to lead in AI. They know this. Trump's trying to save the U.S. economy. Trump's not stupid. He knows what's going on. He sees bonds, and that's why he's screaming to get a new Fed president and get rid of Powell. He wants to ease because he knows if they don't ease, I mean, this could go belly up by the time the next election comes around. And he understands AI. What he understands about AI is going to help the U.S. economy. Unfortunately, it's going to be at the expense of the U.S. worker, but I don't know that they really have a choice. I mean, if you were sitting in office right now, what would your choice be to do? I would think most of us would choose the same thing because we don't really, what else are you going to do? I mean, you can continue to try to adjust the economy to a manufacturing economy, but that takes 20 to 30 years. You have to educate people and build infrastructure. So a lot of what the Trump administration is doing right now is the short-term stuff that they can do. They're managing the yield curve. They're putting pressure on the Fed to ease, sort of against the Fed's will. They're trying to introduce AI to get profits up. We talked about that at the beginning of the video, how corporate profits are up. The problem with that is, what does it do to the U.S. worker? Again, for me, this video today is all about the U.S. worker. And I think gold and silver are telling the tale, but they're telling it from around the world. And if you go to gold and silver, I'll give you one more little tidbit. So I run a gold and silver national store, and we've shifted to doing some of our minting here in the U.S. because it's actually cheaper for me to get gold and silver stock here in the U.S. than it is overseas, because the demand overseas is ridiculous. We're seeing 8 to 10% premiums throughout the Middle East and in Asia over U.S. prices on gold and silver. It's not just silver. We saw it on gold as well. And so we've shifted over to local supply and minting coins in the U.S. And what we're seeing in the U.S. is the prices aren't quite as high because we have U.S. retail still selling.
Gold and silver are sending a message that many investors have missed. Outside the United States, premiums for physical metals are significantly higher, reflecting intense demand across Asia and the Middle East. Meanwhile, U.S. retail investors are largely selling, driven by financial pressure rather than strategic repositioning. Refining capacity is strained, and physical supply is being exported as fast as it can be processed. Futures markets show rising delivery activity, indicating real metal demand rather than speculative trading. This imbalance suggests the current bull market is being driven globally, not domestically.
And what's happened is all the refiners have basically quit. Elemental, 1 week ago, when I was in Florida visiting my friend's coin shop, they said, we're no longer taking silver scrap, we're only taking gold. Well, just yesterday, they announced we can't take gold. They're full because everybody's dumping at these prices. When you're sitting here at over, $111, $112 silver, and what 50 something, what is gold price right now? 52.74. Oh, silver's at 113 at time of recording. People are selling like mad, and it's good if you have the money to buy it. But what's happening is the coin dealers are now broke. They bought so much, they can't buy any more, and they can't sell it to the refinery. When I used to own my coin shop, I would take in scrap, jewelry, whatever. And if it wasn't a coin or something I could resell immediately, I just took it to have it melted. And they would melt it, and I would just play the rates between what I would pay and they would pay. And as long as I made a decent amount, I was fine. Well, now the refiners aren't taking gold and silver. They're full up because everybody's selling everything. It's like, and this goes back to the health of the U.S. consumer. If people were healthy, they may not be selling all their gold and silver. They're doing it because they're defaulting on the auto rates, and mortgage delinquencies are going up, and joblessness is going up, and workers' pay is not keeping up with inflation. And so essentially what happens is massive retail selling from the U.S. public. Anything. I had a guy come in to Daniel's store. I was there last week with a little clasp from a gold chain. It was $40 worth of gold. And the guy, he was sitting there, and in Florida, you have to answer his big, long questionnaire. So he sat there through like a 20-minute questionnaire, because on jewelry purchases, you have to identify who's selling it for theft and things. Interesting. We don't do that in Texas. Long story short, this guy stood there for 30 minutes answering questions to make $40 off of a little gold, 14 karat gold clasp. People are selling. And if you're a gold and silver investor, the encouraging thing about all that is wait until U.S. retail gets in. Wait until these economic issues become more front and center, and people start buying gold and silver at their gold shop. Right now, they're not. They're selling to the point we've maxed out the refiners. But at some point, they're going to turn around and start buying it. And we haven't even gotten to that point yet, and we're sitting at 113. This is ridiculous. $113 silver without the U.S. participating. And a lot of what's happening is the refiners are pumping out this 3/9 silver, either small bars and coins or large bars, industrial size. And I think the rest of the world's taking it, because if you look at who's shorting on COMEX, it's global banks, not U.S. banks. U.S. banks are net long now, and they've been that way for a few months. I think it's international banks shorting gold and silver so that they can take it off cheaper, and they're all taking it out of the U.S. So we're just refining our heirloom gold and silver, jewelry gold and silver, and it's being bought by the rest of the world, is essentially what's happening in the gold market. And that's why you have higher premiums on U.S. gold and silver products and delays, is because there's so much demand, they can't. It's like we're now producing for the world, not just for the U.S. So what does that tell you? It tells you that the rest of the world has a problem getting affordable gold and silver, and we're cheaper by $10 on silver and how many ever bucks on gold. And so now people are coming over here. And that's essentially what I see happening in the gold and silver supply chain. And the only alarming thing from that is, if you haven't started your stack yet and you're interested in gold and silver, you may want to do it, because once that tide turns and the U.S. retail public buys, it's gone in maybe just a few days. There isn't enough silver for 1 ounce for everybody, and not everybody's going to buy, but people are going to come in and buy 10-ounce bars, and they're going to buy 100 ounces, and they're going to buy 3 ounces of gold because they've been, they've sold their car or whatever they did. And they're going to, and when that happens, I don't know where you're going to get the gold and silver, because it's all being sucked out of the U.S. right now by foreign parties. And I know that because they're shorting. Why are they shorting? They're trying to take advantage of the differences in the prices of the derivatives. But more than that, they're trying to take delivery. And for the first time I'd ever seen in 16 years, the January contract of gold, I think it was 8,000 and some, or 5,000 and some contracts that got delivered, whatever the number was, but 8,000 something. But the bigger deal was contracts were being moved forward. Okay, this is a futures market. You take your position in December, then you take it in March, and then you take it in June. They were pulling like June and March forward to January to try to get deliveries. So there is a global run on gold and silver going. The U.S. consumer doesn't know it. They're selling so that people across the world can buy the refined product. And I'm just afraid, Daniel, that this time, when it comes blatantly obvious that we're having an economic crash, I mean, data's there, but it's like the public, they watch TV up until the point of the crisis and like, oh my God, we have a crisis. And then they start Googling it, right? So when that happens, I'm afraid that there's not going to be a lot of liquid gold and silver, because one, you have people sell all their heirlooms. So there's not going to be the native stock in the U.S. And I know that the foreign banks are the ones buying it. You can see it in the trade flows. And I just don't know if it's going to be available as much. And so even at this price, I mean, we're sitting at stupid prices for gold and silver compared to what they were 2 years ago. But even at this price, I'm still buying on a monthly basis, because there's going to come a point where I don't think there's going to be a ton. I think it takes 4 or 5 days of a good U.S. retail run, and the coin shops are sold out. And I think that's what we're headed towards. And this has been the quietest gold and silver bull market I've seen in 17, almost 18 years. I've never seen it this quiet, where the prices got so high and the American public's just like oblivious to it. It's going to be a different animal this time than it was in 2008. In 2008, there were supplies. I don't know if there's going to be supplies this time.
Here's the Google Trends data on the terminology selling silver. So this will tell us how much, and this is within the United States. So this will tell us the volume of people searching out how to sell silver in the United States. And look at that spike up here. This goes back to 2004.
Mm-hmm.
So we haven't had a spike this big in people searching how to sell silver ever before.
Yeah.
Not even the spike here in, 2011?
No, because if you look at what happened in 2011, silver just briefly touched its previous all-time high on a candle. Didn't even end the day that way. And I think that what the U.S. government had done with all the money printing was the economy had started to recover. And now this is going to be different, because I don't know if the U.S. economy recovers. We're talking about the lack of strength of the dollar, the elevated bond rates. What's the U.S. going to do? They're just going to print money, and that's just going to make the problem worse. So this time will definitely be different than 2008, 2010 in terms of how the economy got. The economy's not, the government can't bazooka print a bunch of money and save the economy this time. They've already done that. That was 2008 through 2011, then 2020, 2021. Talk about all the money printing we did during the pandemic. It was a stupid amount of money because they shut down the freaking economy and they had to print trillions. So You only do that a couple of times, and in the life of any fiat currency, and then it's over. And so it's more clear to me that that's why they're going the digital currencies, is because the fiat currencies are all going to die. They're all going to die together.
History shows that no fiat currency lasts forever. Today's transformation goes beyond de-dollarization. It is a restructuring of payment systems themselves. Digital settlement platforms, blockchain infrastructure, and central bank digital currencies are emerging as alternatives to traditional rails like SWIFT. These changes may stabilize trade temporarily, but they do not resolve underlying debt and productivity imbalances. As economic pressure intensifies, monetary authorities will likely respond with further currency expansion. In such transitions, tangible assets historically retain value when confidence in paper systems erodes. This cycle appears to be entering its most consequential phase.